Southwest. Shares are on the move after the company said moderating demand and a shift towards pre-pandemic trends weighing just a bit on the business. You're still looking at gains of just about 1%. CEO Bob Jordan telling investors, quote, as we move into 2024, we are slowing our available seat mile growth rate to absorb current capacity, mature development markets, and optimize schedules to current travel patterns. Taking a look at some of the additional results here within what we're getting from Southwest. They see capacity increasing 10 to 12%. That was down from the prior plans of increasing that as much as 16% through the Q1 of 2024. We talk about sticky inflation. We talk about higher labor costs continuing to weigh on Southwest business. We've seen particular pressure on a number of these discount lines. They're being forced to offer even better sales, trying to boost some of that demand here going forward. And we take a look at the stock performance over the last several months and really since the start of the year. Yes, we're looking at gains today, but shares are still off just about 30% year to date. Over the last 3 months, you're looking at losses of about 34%. It's the worst performer among the 5 largest U.S. airlines. We know they started the year on a rough note when we talk about the outage there, all of the canceled flights, the backlash that we then saw from customers, and now they're dealing with the fact that they could have a demand problem.
Yeah, for customers that are concerned or at least thinking about how Southwest has moved past that, or if they've been able to fully rectify what took place here, just do a hot search for capacity and see what they're talking about on that. And you brought up some of these points that they mentioned within this release, and notably coming directly from the leadership at the company saying that they are flying the full fleet right now. They're completing the restoration of their network, moving into next year as well, slowing that ASM growth rate. You mentioned that, absorbing current capacity, mature developing markets, and then optimize schedules for current travel patterns. Now, those travel patterns, that's what's going to be even more in focus, especially in the fair pricing mechanisms that airlines are going to continue to put forward. So even beyond the holiday season, when you look at the normalization of those travel patterns, that's where for Southwest Airlines, for United Airlines, American Airlines, Delta Airlines, that's where it's going to perhaps be a leaning back into, okay, the stickiness of the ecosystem that they've created, whether that is some type of rewards and relationship that they have on some of their most frequent flyers. And those programs typically, when there is a pullback in demand, you see a leaning into, okay, here are the other incentives that we can add on to make sure that if you do fly, that you're still flying with us. And that's typically where you see kind of that cycle tend to navigate. But it still comes down to capacity and how all of these major U.S. airlines are trying to get back to pre-pandemic capacity in a year where the TSA travel throughput is finally looking like it's going to eclipse on a full year scale the pre-pandemic marker of 2019.
It does, but I do think that a lot of these cheaper discount airlines obviously are really suffering from the fact that a lot of people who are still traveling, they're favoring to go overseas. We certainly have seen the international component from United, from Delta, from American really helping their results. When you take a look at a company like Southwest, the exposure, obviously how much they rely on the domestic travel, the fact that people aren't traveling as much domestically could continue to weigh on their business, especially during this current quarter, very important holiday quarter here for the sector.